Thank you all for joining us today for a market update on the state of M&A activity in the wealth and asset management industry. I'm John Eubanks with Park Sutton Advisors, now a Waller Helms company. Joining me today are Steve Levitt, founder of Park Sutton Advisors, Dave Helms, co-founder of Waller Helms Advisors, and Dan Erickson, managing director with Park Sutton Advisors. We wanted to start out today with just some brief context on the past, present, and future of where we see the RIA M&A market headed, to give some context around the overall landscape, and then we'll jump into any questions that you have from the audience. So we'd like for this to be very two-sided, conversational. Anybody that has questions, you can submit questions through the Q&A function on the webinar. But we'll go ahead and jump right in, and I think it'd be great to start with Steve Levitt. So Steve, having been in the industry for 25 years and working on mergers and acquisitions in wealth and asset management, what sort of changes have you seen in terms of deal economics and just overall deal structure for wealth management firms over the last 15 years?
Sure. Good morning, everyone. Thank you so much for spending time with Park Sutton and the Waller Helms team. We're very excited, by the way, having just completed our combination. In terms of how deal economics have evolved, I would say they have moved materially over the last few years. A few years ago, you might have seen 50% paid for a wealth manager at closing. And depending on the size of the firm, you could be looking at 5 to 8 times EBITDA. I would say even for small firms, namely $500 million assets under management, we're now seeing much higher percentages being paid at closing, sometimes 80, 90%. And that's off of, and these are EBITDA multiples, which are higher, often over 10 times EBITDA, sometimes 10 to 15. And they're multiplied by the adjusted EBITDA, so including cost synergies. Also, payout terms are shorter. Used to be you'd get paid over 3 to 5 years. Now it's often 1 or 2 years.
So, Dave, question for you. Given the interest rate increases lately, how do you see financing costs potentially impacting the activity of M&A for RIAs?
Yeah, sure. Yeah, happy to address that, but also we just want to say thanks to everyone for joining. And yeah, we couldn't be more thrilled to be partnered with the Park Sutton team. Our firm is a boutique investment bank focused on the insurance, wealth management, healthcare services, and financial technology sectors. And obviously, this partnership significantly enhances our capabilities and expertise in the wealth management sector. So we're thrilled. Across our two firms, I think what we're excited about is I think we've closed close to 75 transactions in the last 18 months, and that activity, that access, the information that provides, we're thrilled about the additional value, the incremental value that we're going to be able to deliver to our clients as a combined firm. So wanted to at least acknowledge and share that first in terms of how excited and why we're excited about this. With regard to interest rates and impact on M&A in this sector, I think the good news is this lenders remain very open and interested and attracted to the wealth management sector, as well as our other sectors, both insurance and healthcare services. There's the significant recurring revenue, and predictability of that is something that has attracted quite a bit of debt capital over time, and the lenders continue to like it. Even with the cost of debt, frankly, close to doubling in the last 12 months, it remains a very attractive source of capital for companies, acquirers, private equity firms, et cetera, to utilize for M&A. So I think the impact is really most on kind of the amount of dry powder lenders are willing to commit to companies in today's market. I think the interest rates going up, and then the volatility in the investment markets has created less cushion from an interest coverage perspective, and so I think that impact is being felt in the form of smaller kind of delayed draw term loans or acquisition lines that companies have available to just draw on with their own based on their own direction. I think they have to go back to lenders for incremental debt as opposed to having that sitting there on the shelf. The impact, our sense is obviously there is incremental cost to it, but the bigger impact is really more just kind of the amount of dry powder that acquirers have sitting by, they're standing by, and potentially that's enhancing kind of how discerning they may be about the targets that they pursue.
Thank you. So Dave, Dan, sort of playing off of some of Dave's comments there about access to capital maybe slowing a little bit. What have you seen, or what have been your observations in the last 12 months as far as changes in the market, and then secondarily, where do you see this going from here in terms of number of transactions and valuations, and just where we think the market's headed?
Yeah, sure. And thank you as well to everyone for joining today. So I would say first that our pipeline remains really strong going into next year. And what we've heard from discussions with various acquirers out there is they have a lot on their plates as well, with deals closing even over the next couple of quarters. So I think that now through probably the first half of next year, we're going to see a wave of deal announcements. As we sit here today, the market volatility that we've seen over the past year and the rise in interest rates, we've not seen that affect valuations on the aggregate. Perhaps as a result of higher rates, we could see this change over the next 6 or 12 months, depending on where rates end up. What we do see is some buyers being more selective. So picking their spots a bit more. We're receiving fewer offers for clients than we had in the past. But again, at the upper end of the valuation range, and for really solid firms, the market continues to be as strong as it's ever been. So I think from a historical perspective, we're much closer to a valuation peak than we are anywhere else. From a succession planning perspective, I think we're going to see groups continue to be more focused on what's best for their clients, what's best for their staff, and not just simply valuation. And I think that if partnering with another group makes sense from those perspectives, then they'll do so, because again, the valuations are still quite strong too.
I would just add multiples are still higher than where they were 1 or 2 years ago. And by the way, we just had a deal announced today, Wealth Enhancement Group buying BTR in Oakland, California.
Yeah, and I think one important comment from Dan there about buyers being slightly more selective. What I think this has really done, at least in our observation, is that as these acquirers have focused on the highest quality firms or certain geographic markets that they really want to prioritize, well, what's happened is then that has sort of supported the multiples and the valuations in the highest quality firms that are coming to market. So I think important note there is that yes, we are seeing maybe slightly less activity and interest for certain firms than there was a year ago, but recently that has as they've reprioritized to the highest quality firms out there, it's supported valuations at those levels as well. So I think what we'd like to do now is open up the discussion for questions. So as anyone has questions that you want to ask, please feel free to use the Q&A function. We did have a couple of questions that came in before the webinar started. So I'll start with the first one, and maybe this is a good one. I'll come back to you, Dan. Are there any new buyer profiles that you have seen emerge recently in the wealth and asset management space?
Yeah, so this is something that we've talked about for quite some time now. You know, we knew that there are maybe 30 private equity backed insurance and benefits brokerage type firms out there. So like an Alara Group or a One Digital or a Gallagher, though they're publicly traded. And you know, there's been this convergence of insurance and wealth. And we knew that there were groups like those that I named that were seeking to expand what they're doing in wealth management. So we did a deal with Alara earlier this year. They see lots of synergies across wealth management, retirement, employee benefits, insurance brokerage. So that would probably be the most notable group that I would say has come into the market over the past 12 or 18 months. I don't know if you know, Dave Helms, coming from that space, if there is anything else you'd like to add.
Yeah, no, I think that's exactly right. Listen, that was part of you know, why we started talking. We and Steve started talking, and with you guys 12, 18 months ago, was we saw this coming, and the increase of activity across the sectors and the strategic rationale behind it, which is solid in terms of a lot of common themes and opportunities between the two industries. And so that insurance brokerage landscape, the insurance distribution landscape, is where we've been extremely active for the last 25 years, frankly. And so those groups are folks that we have terrific relationships with, similar to the depth of relationships that you all obviously have on the wealth management side. And so bringing that together, it gives us gives us great access and insights, which benefits obviously our clients. And then on top of that, I think private equity is opening up to frankly a wider range of sizes as they think about platforms. I think because of the attractiveness of the sector, there's a willingness to if they can find a strong team, and maybe it's not it's not something that they would have considered a platform in years past, because there's so much desire to find a platform. There's a willingness to lean in and partner with a really strong team that has a demonstrated interest in growth, both organic and M&A. So I think it's obviously a terrific slate of wealth management buyers. Insurance distribution are coming in strong in terms of their interest, and private equity's interest is expanding, and there continues, even in a challenging or dynamic environment, continues to be a significant amount of dry powder there that's looking to be put to work.
Well, one other comment that I'll make with respect to some of these benefits and insurance PE-backed brokers, I think that with even some of our clients, there's been some initial hesitancy to do a deal with a group like that because they look so much different. But then once they're in a conversation with them and they start learning more and learning about the synergies and some of the interesting things that these firms are doing, they become much more open-minded to it. So I share that because some on this call might be thinking, well, I would never do a deal with a group like that. But that could change after you meet some of these people and learn a little bit more.
Several of our clients have chosen to do deals with them. KB Financial with One Digital in New Jersey, Johnson Brunetti with Alara up in Connecticut.
So Steve, taking it a little bit further on, buyers in the market, we are getting a few questions about valuations and types of buyers. One specifically about minority investors and more permanent capital. So maybe speak briefly to what we're seeing in terms of those minority investment options, longer term permanent capital, and what that looks like.
Sure. I think that versus some years back, there really is a wide array of minority capital options for wealth managers, at least of a certain minimum EBITDA level. And I don't know where that might be, but maybe even just 2 million of EBITDA. The permanent capital or long-term investors, groups like, TRIA, Emigrant, Copley, there's a whole range of these. And then also I would say the private equity firms in some cases are also open to pretty long-term holds, not indefinite, but maybe where they might look and agree to a 7 or 8 year hold. And I mean, we continue to be contacted by private equity firms we hadn't heard of. I mean, for instance, recently, I think Valeas, I hope I don't have their name wrong, invested in Sequoia Capital. And I mean, that's a relatively new private equity firm. We're continually being introduced to new ones. So there are many groups who I think are looking for minority and majority stakes. Sometimes the minority stakes aren't at the discounted valuation that one would think. I was speaking with one provider along these lines, and he told me yesterday, in fact, that he sees more and more groups coming to market looking to sell minority. And in his case, a lot of these deals are involving 14 to 16 times EBITDA being paid with some structure. So I think it is very competitive, and not necessarily the case that there's the discount one might assume for a minority versus majority transaction.
That's a great point. The other thing I might say is that some of these minority stakes obviously are not reliant on debt. So the interest rate movements or availability of debt capital isn't impacting appetite there, or potentially wherewithal there as much as it is for the full buyouts or strategic sales.
So here's another question sort of related to this in terms of valuations, and I don't think necessarily getting too specific, but just in terms of differentials between multiples or premiums for a strategic combination versus maybe a permanent capital minority. Dave and Steve, I'll start with Dave. Dave, maybe you want to speak to what you've historically seen in differences between strategic acquisitions and more permanent capital, or I guess more of an aggregator sort of structure.
Well, I guess the most obvious differential in a strategic versus a financial investor is the opportunity to leverage the two firms and potentially find opportunities for synergies, which in this market, which remains even if the market is a little bit more dynamic than it was 12 months ago, it's still overall there is strong interest, and so there is an ability for sellers to capture value for those types of things that may be created in a strategic sale. So that's one consideration, and those can take a variety of different shapes. And frankly, they can be both on the revenue side as well as the expense side. But frankly can move the needle quite a bit depending on an individual situation or the margin. The base margin that a seller may have. So I think that's a significant one. And I think what's key there is having an advisor, having the information on how those buyers think of acquisitions, how they think about integration, what resources they have in their firms that you can frankly then put together, take your own crack at putting together what a pro forma financial statement would look like, and frankly provide that roadmap to value that is enabled sellers to really achieve some terrific results in strategic sales where that's something people are willing to consider.
Steve, anything else you would add there related to strategic combinations?
No.
So another question, and I'll give this one to Dan. Considering current rates, inflation, market volatility, what advice are your clients seeking right now?
I think that people are interested to understand what's changed as a result of these things. And as I was mentioning earlier, it's, maybe in our processes, the average valuation has come down a little bit, but the offers at the upper end have not. So, I mean, it's still very, very strong. And I was talking with a PE-backed serial acquirer the other day, and what he was saying to me is the view of their PE sponsor is that if rates are up and the cost of capital has increased, even if the acquirer is breaking even on their debt service, meaning the added cash flows that they're getting from a transaction are near the interest costs from the debt taken on to make the deal happen, that's still a win at the end of the day because there's this multiple arbitrage that's able to be captured. You have a seller that might be worth 10 or 12 times EBITDA and a buyer's worth 15 to 20. So again, there's still that arbitrage. As far as, you asked about advice, but I would say, as far as getting a deal closed, like, is it more challenging? Is it the same? Look, I think it's absolutely gotten a little bit more challenging than it was over the past couple of years when, it seemed like every buyer wanted to buy everything. So there was a little bit more negotiating leverage there. But look, over the last year, you have revenues bouncing around with the market. Inherently, sellers, they want to be valued when the revenue is at a peak. I think most buyers out there, though, they're trying to be thoughtful. They're trying to be fair. And look, at the end of the day, sellers have options. So if they're unhappy, they can likely pivot toward another potential partner in a process. So while it has become a little bit tougher, we don't really have firms going back to market. The deals that we're working on, they're generally getting closed.
I think what I would add on this is, look, John, I mentioned initially, I've been doing this 25 years. We remind clients 10 years ago, a successful sale process, you might get 3 offers, not 10, 15, or 20. So, even if there are, a handful of groups who are a little bit more strapped for capital, it's still a very, very vibrant market. It still is a seller's market, although, again, it has gotten more nuanced. And, as Dan just said, some months back, some buyers would almost buy anything. And we're not quite seeing that because of the rising cost of capital. They are being more selective, as they probably should be. I would also just make one other comment. We are having lots of conversations with all of our clients. Given the market volatility, these firms tend to get priced off of run rate EBITDA. So as Dan said, human nature being what it is, people want to get priced off the top. And I would say that, 930 was down for the year. And, it really wasn't the case that our sellers were either getting priced then just on that 930, which may have been a bit of a low. There's a lot of negotiation around this because at the end of the day, as Dan said, look, if a buyer is not going to be reasonable and they want someone to price it at a recent bottom, they'll just go with someone else. So there's a lot of discussion about this, but we haven't seen the volatility actually impede our deals getting closed.
Yeah.
So staying on this structure for a minute, or on this topic for a minute and related to deal structure, a question for Steve. Are there any observable differences you've seen in deal structures in the last, say, 3 to 6 months as compared to a year ago, given where the market is?
I know that some buyers talk about using catch-up mechanisms. I really would just say that both sides are going to have to give a little. No, your deal's not going to get priced off of run rate from 1231 or 331 probably. So that's probably an unrealistic seller expectation. On the other hand, getting a price off of 930, that's not reasonable either. So in some cases, I know what we've done with some of our clients is we actually look at a run rate based not on just 1 quarter, but 2 quarters. And then, we'll use that. But, we haven't yet seen real impact in our deals, again, because it's a seller's market and it's very competitive. That doesn't mean to say we may not see more of it, and maybe there is a lag from some of the effects of these increases in interest rates. We are aware that some of these aggregators are extremely leveraged. So not to say it's not coming, but we haven't seen that much of it yet.
I think one of the interesting things here in all of this that I think is important for owners, founders, partners, and wealth management firms to consider is where we are in the consolidation of the wealth management industry. And I think that Dave would be curious to hear your thoughts, but some experts view the insurance industry as a good indicator of where consolidation may go in wealth management, just because among independent insurance brokerage, that industry started consolidating at least 5 years, maybe 7 years ahead of wealth. Is there anything that you've seen in the insurance space or any lessons you think RIAs can take from looking at that space related to where we are in this market cycle potentially, or just overall takeaways from that industry?
Yeah. And frankly, it may be more 10 to 20 years ahead. The consolidation in insurance distribution has been going on for a long time, and there's and it continues, frankly, at this point. But we do see some parallels given some commonalities of the business models and impacts on the market, et cetera. And that's something that has us excited. And I think maybe a key point I would make is there is room for a number of winners, right? I mean, if we look at the insurance brokerage landscape, there are a number of public companies. There are a number of private equity backed, very large private equity backed businesses that could be public if they chose to be, but frankly have used the private markets. And there's a regeneration of new firms coming, of people breaking away and starting those firms and building again, which is another theme that I think we're seeing in wealth management from a breakaway perspective. So I think that what's exciting to us is there's room for more than one winner, well more than one winner. I think and those will be shaped. The key really is around leadership and execution, and great teams and strategies that are different can be equally as successful, whether it's a different culture, whether it's different specialties, whether it's different geographies, different client focuses. There's room for multiple strategies, and there's a ton of runway for this wealth management sector. And I think a challenging, frankly, environment is just from a market environment. I think it just continues to point out how much advice is needed. And so yeah, I think there's a terrific landscape of great firms in the insurance brokerage space, benefits consulting space. I think it's gonna look similar in wealth management, 10 years from now, in terms of a wide array of firms, but with some very large firms at the top. I wouldn't be surprised several of those being public or more than today, but a terrific universe for kind of continuing regeneration, whether it's from some of those large firms or the wirehouses and the breakaways that'll continue to create opportunity and activity in the space.
In terms of timeline of getting transactions done, a question for Steve. What is the current timeline to sell a wealth management firm, and has that changed from 2-3 years ago?
I think that the timeline to close a deal is shorter than it was 3 years ago. We used to tell clients to expect it to take 9 to 12 months from start to finish to close. And I would say assuming the client does their part, which is they fulfill a due diligence request quickly and they're responsive, and they're not telling us, yeah, I'm away on a cruise for 3 weeks and can't make Zoom calls. I mean, if they're engaged, given that this is an important process, we can close the deals these days in 6 to 9 months. In some cases, last year, with that rush to close by 12/31 because everyone was concerned about taxes, we had some deals even close within 6 months. So it definitely is shorter than it was. The last 2 years they were concerned about taxes. I feel like that's not come up as much this year, sort of this run. But again, we do have a whole flurry of deals that are going to close by 12/31.
So, we talk a lot about seller's market versus buyer's market. I think we would all agree it's very much been a seller's market for the last at least 5 years, probably longer than that. We would like to have kind of weigh in from each one of you, really, I think would be really helpful to hear. So maybe we'll start with Dan in terms of, are we in a seller's market, and, what potentially changes this to be, flip that up to the other side and potentially become more of a buyer's market?
I think we're absolutely still in a seller's market. I think that the increasing cost of capital, it's not great for either side, but because there is still this imbalance between buyers and sellers, I do think that even just that fact helps to sustain valuations. What makes this become a buyer's market? I don't know. I don't know that we necessarily really see one for the foreseeable future. So I'll pause there.
Steve, any thoughts there?
Yeah, look, I think that top firms, and by that, we're talking about firms that have true organic growth, maybe 5 to 10% plus per year, institutionalized businesses who are working with clients with solid client demographics, firms that are really operating as a team, firms that are providing financial planning. And I believe that the marketplace is moving towards more of these wealth managers being more of a one-stop shop. I mean, I particularly believe this even for myself as a client of wealth managers, and what I need and seek. So I think that I truly believe that for those top firms, even if multiples, which are very high, do come down, I mean, I do believe that they're going to continue to be sought hotly after, particularly firms with some scale, meaning at least $1 billion AUM. This wave of M&A with high valuations has kind of lifted everyone. And, I wouldn't be surprised, though, if we start to see some firms of lesser quality, maybe they lack bench strength, maybe they really don't have organic growth or a real differentiated value proposition. I could see buyers, for all the reasons we've discussed, being less interested in those, and valuations and demand declining for the lower quality businesses.
Yeah,
Dave, anything?
I would tend to agree. I mean, I think, listen, the model works, right? I mean, I think we've seen that scale can indeed create value, can create better firms, can create better client experiences, and so the fact that growth of both the buyer and the seller, if it's done right, will be enhanced by coming together, continues to create an environment where deals, even at current valuations, are accretive and value building for investors. And so given the a larger field of acquirers with insurance distribution players coming in, with private equity continuing to be very interested in the sector. I think, again, I think everybody's right. There's going to be people are going to have to be a little bit more discerning here in the near term as capital is a little bit trickier to navigate, but But even with that, great firms, organic growing firms, specialist firms, firms in attractive geographies or markets that people want to enter, scarcity is still going to drive value. And so if there are unique aspects of the firms, whether it's growth or any of the other things I just mentioned, I think we'll keep it a seller's market for those firms. And if marketed well and the story is laid out well and a picture of clear value for an acquirer is painted. So I do think it's important. And listen, this is part of why, another reason why we're so excited to come together is between Park Sutton's deep industry expertise and relationships and our experience in the capital markets and understanding investors as well as the debt markets and kind of how that all fits together. I think that's going to be vital for sellers to really understand the whole picture to ensure that they get the best result possible. And so we're excited about it and think we're truly unique in terms of our ability to deliver that to the market.
Well, one other comment that I'll make, John, is I think that some of these groups that you see doing lots and lots of deals, I think they would like to get to a point where they're not doing so many. But part of the issue right now is there's a shortage of good advisors. Arguably, if an advisor is really, really good, they're probably running their own business. So the only way to get those people is to acquire them. I mean, you're not just going to be able to hire them away from their own business that they're running. So I think we're perhaps at some point, these firms, the wealth enhancement groups, the Mercers of the world, they're at a place where they're grooming enough advisors internally. The industry has evolved enough. They're able to do that and train these people. But I think the way that the industry sits today, it's very challenging to do that. And the best quality advisors are the ones that are running their own firms. So, that's something that could shift the landscape at some point.
Yeah, that being said, I think they're great advisors, but they're frankly distracted with running their firms in many cases, or having to deal with a lot more than being advisors. So that is, what again goes to why we think activity will continue, is because of the amount of value, frankly, the amount of time that can be filled up or freed up for kind of leading players to do what they're best at, which is grow their firm if they can offload some of the things that come along with being owning the business and having a lot of responsibilities beyond client activities.
So with this market we're in, Steve, you've having done this for as long as you have, you've lived through and advised clients through more than just one bear market in the stock market. So what do you see in terms of the current market volatility, where we are today? Do you see any potential to come to a point where deals just essentially come to a grinding halt? Or if not, what do you see in terms of the potential impact on deals in the current market?
I don't see the activity coming to a grinding halt because the industry is still so fragmented. I think Dave alluded before, the number of advisors is even increasing. I was at a Fidelity event this week in New York, and I think I have the number right. I think they said in 2022, there were 1,000 new RIAs created. So, the number continues to go up, which is greater than the number of transactions. And it's just a very fragmented industry. And to Dan, John, and me and our team working with sellers, even the best of them, there's only so much one can do as a small independent firm. There was a terrific firm we met. Unfortunately, we're not hired by them in Massachusetts. Wound up selling to EP Wealth, a terrific firm, great people. And I just thought, as great as they are on their own, they were managing around $1 billion. I just knew it's part of a platform with access to deeper bench, research, other capabilities. I just think that these large aggregators who are able to invest many, many millions of dollars in technology, research, AI, marketing, you name it. It's very, very hard for the small firm to truly differentiate and compete. And I think that's going to continue more and more over time. And, running a small firm, there's so much admin as I had, which is one of the reasons also I wanted to be part of something bigger, that I don't think we're going to see this consolidation. As Dave also said, there's so much dry powder from the private equity firms to consolidate this space over the next few decades. I don't think it's going to stop. If anything, I just think it's, as we've discussed, probably the buyers get more selective what they're willing to pay for what.
Yeah, so I think we are running up on about 45 minutes here. We've got about 5 minutes left. So I think it'd be great to wrap this up with some thoughts on individual perspectives from each of you on, where do we see 2023 versus 2022 and potentially beyond. So Dan, I'll start with you. Any thoughts on, 2023 and what potentially that looks like in terms of transaction activity?
I think that the first half of 2023, we're going to see lots of deal announcements. Some of those, are likely processes that were kicked off in 2022. And then, who knows what happens with rates? I mean, we've been talking so much about rates going up, but, there's a scenario where rates start to come back down again too, when cost of capital goes down and the market's not so volatile and there's a little bit more certainty out there, and things look pretty bright in the second half of next year. So like everyone else, I don't have a crystal ball, but I think that it's probably on the whole going to be a very, very strong deal for deals again, just like it was last year and the year before and the year before that.
Dave, anything you would add?
Listen, I think we're the markets we focus on, including wealth management, but also insurance, healthcare services. There's sectors that are large, important, sectors that aren't going away, and I think I think what have weathered all of them, weathered storms in the past that we've all had a chance to see how companies enter some of these storms and then come out of them, and in most every case in these sectors they've come out of them as well as or better than they've gone in, and I think and as individuals but also as a sector, and each time we've kind of gone through a downturn, we've frankly come out with more interest, from, especially on a risk-adjusted basis, more capital drawn towards the sectors we cover than there was going in, and they were healthy going in. So I think Dan's exactly right. Listen, in the near term, there's some choppiness, but in the mid long term, this is a great sector. The runway is there. The capital is there, seeking opportunities, and we may see lift in interest because capital that maybe used to be focused on other sectors that come out of a downturn, those other sectors end up more beat up or less investable than they were going in. That capital still needs to be put to work somewhere, and this is a terrific sector. So we feel great about the mid to long term, and certainly not bad about the near term. There continues to be good interest, but it is a little bit more discerning at the moment.
Yeah. Dave, any additional thoughts?
Yeah, no, I agree with everything that Dave and Dan just said, and maybe the one further comment would be, well, look, who knows? Things can always change, but I think this is a solid long-term investment opportunity and consolidating sector. And, I, for one, have found it really intriguing how large some of these RIAs are getting. And again, I tell people that just a few years ago, it was hard finding a buyer willing to write a $30 million check. And I mean, some of these large RIAs are truly becoming, institutionalized businesses, starting with Edelman, which is very, very large, backed by Hellman and Friedman, to more and more of these others have valuations over $1 billion. And so, I mean, this is not something I ever would have imagined 5 years ago. And again, it's one reason why I thought it important for us to, even come together as a bigger firm to go after some of those opportunities as this industry in its early innings, will continue to mature.
Yeah, one add-on point to that. So, Steve, you're exactly right, and I think the power in coming together isn't just going after more of those larger deals, which we will, and we'll be successful. But I think what's exciting and what informs us is the fact that we're working with billion AUM platforms. We're working with 20 billion plus AUM platforms, and that's today. We have a wide range of firms in the marketplace, and what we gather and what we learn through those processes and that work is flows to it informs us. And I think that's what understanding kind of how firms across that spectrum think and approach the market. We want to continue working across that full spectrum.
Yeah, and actually, that reminds me one other comment I'll make too. We as a team, and we're all very much about a team approach. We're very much making an effort to meet with a lot of the top active aggregators, acquirers, and so look, if there are folks on the phone we haven't connected with, in doing our job where we're largely working, with these sellers, we really want to make sure we understand the buyer universe as well as possible so that we can be offering, the best guidance possible to our clients. So if there are folks listening and you think, Park Sutton should spend some time with us, please let us know. We're proactively doing this with other groups.
And I just want to say appreciate everybody taking time out of your day today to join us. We hope that you found this helpful, and we did get a number of questions we did not have a chance to get to. So, of course, always feel free to reach out to any one of us on the phone at any time. We're happy to answer any additional questions that you may have about the market, environment, or any of the other topics that we discussed today. But again, thank you all, and hope you all enjoy the rest of your day.